Well, hello everyone, and welcome to this conversation hosted by the IMF on how to chart a course for European economic renewal after the pandemic. My name is Sam Fleming. I'm the Brussels Bureau Chief at the Financial Times, and I'm delighted to moderate this discussion between Kristalina Georgieva, the IMF's Managing Director, and Paolo Gentiloni, the EU's Economics Commissioner. Our two very distinguished panelists need very little introduction, so I won't waste too much of our time with biographies. Just to say that Kristalina Georgieva has served as the IMF Managing Director since 2019, before which she was the Chief Executive of the World Bank, previously a European Commissioner under the Juncker and Barroso presidencies. Paolo Gentiloni has been the EU's Economics Commissioner since 2019. He's a former Prime Minister of Italy from 2016 to 18, and before that held ministerial posts including Foreign Affairs and Minister of Communications. Now, before I go any further, just to remind you, if you'd like to ask questions to our panelists, do just tweet me. Send me a tweet to my Twitter handles at Sam1Fleming, and I'll keep an eye out for questions and put a few questions from the audience towards the end of our discussion. But before that, let's go into our opening dialogue. I mean, well, what a difference a few months can make. Last autumn, the IMF was talking about a long and difficult ascent from COVID-19, whereas we had the spring meetings over the past few days. The fund has been a lot more optimistic, at least as far as the advanced economies are concerned, talking about hopefully not actually that much long-term economic scarring from COVID-19 and global growth overall, about 6% this year and 4.4% next year. So what are the fiscal implications, policy implications for this outlook, in particular for the European Union? Clearly, there are enormous uncertainties right here. We've seen so many disappointments over the past year as we try and come to grips with this pandemic. Only today, new concerns about vaccine side effects. So it's obviously an extremely uncertain time. But let's think through what we actually do see in terms of the economic outlook now. Let me start with the IMF Managing Director. Kristalina Georgieva, could you talk a little bit about vaccine policy right now? I mean, vaccine policy is, in a sense, economic policy. And we've seen in recent weeks a lot of reports when we talk about the European Union, about a very sluggish vaccine rollout, at least compared with the United States. Do you see greater reason for optimism about the European economic outlook, given where we are in terms of vaccines?
Let me start by saying that it is exactly vaccinations that have brightened the horizon for 21 and beyond, but also combined with two other factors, we should not ignore them. One is the massive policy support that has been provided and put the floor under the world economy. And second, the fact that we have learned how to function with the pandemic still around us. When you look at mobility indicators, the current wave is quite severe, and yet we are not registering the same negative impact on the economy. So it is these three factors combined that have lifted up projections for 2021. Among them, as you rightly said, vaccinations remain the number one economic policy factor. We have calculated that if the world was to accelerate vaccinations, we would gain some $9 trillion of output between now and 25, of which 60% would go for emerging markets and developing economies, 40% would go for advanced economies. And by just lifting up vaccinations everywhere, they would collect some $1 trillion additional in taxes. So there is no question in my mind that the best public investment any country can make is to contribute to accelerating vaccinations. And that, of course, applies to the European Union. What we are seeing is policymakers, rightly so, are concentrating on vaccinations, and we see some signs that this is bearing fruits. In our projections, we expect that in the second half of the year, the Eurozone and broadly the European Union is going to catch up in terms of growth. And on that basis, we are putting growth projections for the Eurozone at 4.4%. Broadly speaking, Europe growing at 4 to 5% in 21. If we were to be pressing a bit further in our conversation, and I'm sure we would get to this point, we need to look at the risks. And you were so right, Sam, to say that there is a great deal of uncertainty. We don't know how mutations are going to continue to affect us. We are not very clear around the bad news that may come with good news. In other words, when growth accelerates, it is going to impact prospects for interest rates. For now, we are hopeful that we are not going to see any dramatic shifts, but it is a source of uncertainty. And we are also still to do the very important transition from more uniform support for businesses and households to more targeted support. And how successful we would be would determine rate of bankruptcies and risks of unemployment. So we should not relax. We should not be complacent. There is a lot to do in the months ahead.
Gentiloni, back in February, the Commission said already it was seeing some light at the end of the tunnel when it put out its forecasts at that point. Obviously, that light of the tunnel, there, as Kristalina Georgieva has explained, that isn't only down to vaccines, but obviously it was a key reason for your optimism or relative optimism back then. The IMF is forecasting a more punchy economic outlook, at least this year, for the euro area than the Commission was back in February. Are you expecting to upgrade your forecast when you next put out the next set of economic forecasts in May? And if so, why? What are the reasons for being more optimistic, if that is indeed where things are headed? We can't hear the Commissioner.
Well, thank you for this conversation. I think that Kristalina framed the analysis that we should have. In a certain sense, I think we are going from a situation where uncertainty or even unknown situation was prevailing towards gradually the situation where we have risks, but not only unknown and uncertain. And on the basis of this new situation is, of course, the fact that we have this famous light at the end of this famous tunnel. Indeed, we don't know how long this tunnel will be. From our point of view, I think that the European Union had a very strong and extraordinary reaction in 2020 to the crisis. I have to say, much stronger and faster than reaction in previous economic crises. And for the first time, we have not only fiscal rules, but also fiscal tools at European level, which is, as you know, unprecedented. At the same time, we are perfectly aware of the fact that this is not like a war when at a certain point the fight ends and the peace begins. We will have a transition where recovery will be underway, but at the same time, we will be fighting COVID, the variants, and having the difficulties. From this point of view, of course, I know that the EU experienced problems in the first phase of vaccination rollout. I think that we are now accelerating. Just to give you a number that you know very well, we had in the first quarter a little bit more than 100 million doses, and we will have 3 times these figures, around 360 million in the second quarter. and vaccination per day are now around 2 million per day, and they will grow in the next days and weeks. But difficulties were there, and for this reason, we have a strange situation where we have optimism, where especially manufacture learned to coexist with the pandemic, and also in the services, the recovery is underway, but at the same time, we still have stringency measures in several European member states. So we will have this contradiction for a certain time. Our forecast is that in the second half of the year, the recovery will gain speed, and probably our forecast that we will have in 1 month from now uh, will be more optimistic. Well, we don't have the figures, but could be more optimistic than the one that we had in winter. We had an idea of 3.8 growth for the Eurozone in 2021. And as Kristalina remembered, the IMF outlook is a little bit more optimistic. And this is quite possible because the recovery, despite the fact that we are still fighting and we are still with stringency measure, the recovery is underway.
But let me push you a little bit in terms of the EU, and let me compare it with the US. So looking at the IMF's numbers, the contraction in 2020 was nearly twice as large in the euro area as the US. And the US is, at least again, these are forecasts, they'll always turn out to be inaccurate. That's the nature of forecasting. But the US, at least according to these forecasts, going to markedly outpace the euro area this year. Does that reflect serious damage from the EU's point of view from the slow vaccine rollout that we've seen?
Well, I don't think that we can only address the differences that we have and we will have between US and EU and Europe overall only because of the timing of the rollout of vaccines. We all know the differences that we have, institutional, economic, and also differences in previous years' growth rates. What is important for us, I think, is that the fiscal and economic reaction that European member states, and for the first time also common tools, had in these months was able to cushion the impact of the crisis. We had in 2020 a decrease, a negative growth, a little bit less negative that we expected, and we are now in a positive way. For Europe, a growth rate of 4% or even more than 4% for some years would be very important. And of course, what we are working on is the quality of this growth, because we need to have not only a rebound of what we lost in 2020, but we need to use this rebound to have a more sustainable and resilient and competitive European Union. So the comparison with the US is important. I know that if we want a few numbers, we had maybe 2/3 of the fiscal reaction in comparison to the one that was from US in 2020 and 2021. It was 13% for the EU and near to 20% in US. But this difference, I think, is for us to continue to support our economies. It's not a reason to underestimate the importance of the reaction that we already have. I repeat, an unprecedented reaction.
Kristalina, Georgieva, could I ask you on the same point, when we talk about the difference between the EU and the US economic story, one of the big points of discussion right now, which Paolo Gentiloni has just alluded to, is the scale of the fiscal response that we're seeing in the EU and Euro area versus the US. And clearly there's a perception that the EU fiscal effort is not sufficient compared with certainly the large package from Joe Biden of 1.9 trillion plus potentially an infrastructure package on top of that. What's the IMF's assessment of this difference between the fiscal responses of these two economic powers? Would you like to see more from the EU in terms of fiscal effort this year and next year?
Since the crisis is not quite yet over, since we are still faced with difficulties, early to take a victory lap. But it is important to state that the US, the EU, other economies with fiscal space have done remarkably well to act swiftly and decisively on a very large scale. If we didn't have this action, the recession last year would have been 3 times deeper. It would have been in the neighborhood of a depression. So let's give credit where credit is due. In terms of the comparison, let's recognize that we are comparing apples and oranges. The EU has some automatic stabilizers that have kicked in, especially in terms of job rotation schemes. At the peak of protecting jobs, 68 million people were not pushed into unemployment because of these job retention schemes. And he also applies much more guarantees that are below the line, so you don't see them. And when we looked at the differences between the EU and the US, both last year and this year, what impressed us was that more of the difference is due to, if you wish, structure of the economy and restrictions applied to protect people against the pandemic. The structure of some of the European economies, much more contact dependent, much more tourism dependent, led to dramatic drop. If you look at countries like Spain, Italy, France, this drop of output, which continues and will continue for some time because of the impact on their core tourism, hospitality industries, is different from what we have seen in the United States. And also measures that have been applied in the US in terms of restriction of economic activities have been in relative terms less profound than in the EU. I'm not an expert of epidemiology, so I'm not going to speculate, but there are differences in terms of density of population, in terms of travel, travel modalities, how people move from one place to another between Europe and the United States. So we have to recognize that. But of course, the fact that US is putting forward a two-step support for the economy, a very big relief package, and an infrastructure package is important. So how does that compare to measures in the EU? And how do I answer your very direct question? Should you do more? It compares, relatively speaking, favorably. The EU came up early with the new generation EU package, which is in a way a model by which the forthcoming infrastructure green package in the US is put forward. It is also in relative terms the way Europe is looking into gradually shifting support, very similar to what the US is doing. Can the EU do more? Can the Eurozone do more? And what we see is, yes, the EU, not all countries, but most countries do have fiscal space. And stay tuned. Tomorrow we are going to issue our regional economic outlook update for Europe. We would make this point that well-targeted additional fiscal measures can boost growth in the EU and can reduce scarring. So that is for policymakers in Europe to consider, and I'm sure they will. We have been long advocating for a coordinated green investment push to help the transition to the new climate economy, but also to lift up growth and jobs in Europe. We have been advocating for more attention to what measures are appropriate. And let me make two final points in this segment. One, there is critical attention to be paid to packages of measures to be not just financing, but also reforms. Europe has space to improve its competitiveness. We know it. Europe does know it very well. And for this reason, the new generation EU calls on countries, please give us your investment plans combined with a package of structural reforms. And the deadline is knocking on the door. It is end April. So very important that in terms of support for labor market flexibility, being able to move people from declining sectors to expanding sectors more rapidly, that this is a center of attention. And two, we know that the next shoe to drop could be bankruptcies. And therefore, attention to how to support viable firms is going to be absolutely essential everywhere, including in Europe. Our research shows that uh, we have to move from liquidity support to equity support, and that in Europe, the equivalent of some 2 to 3% of GDP injection of equity would be necessary for viable firms to continue to provide employment. And we are talking about employment in the order of 15 million jobs. So my point to finish my point is that yes, Europe has some fiscal space. It would be much more about the quality of how this fiscal space is used, and so very important that it is on the backs of recognizing the removal of some obstacles to growth that are related to competitiveness of Europe. That this is a focus of the next round of action in the European Union.
Let me take this. There's a lot to think about there and some really interesting points to put to the Commissioner. First of all, the idea that there's fiscal space still in the European Union and well-targeted additional measures could be appropriate. Certainly, we are seeing some member states push through or prepare additional budgetary packages, Italy obviously being one of them. There's allied to that a debate about which Emmanuel Macron has referred to recently about whether the overall EU level response needs to be larger, the recovery fund itself. Commissioner, I wondered, first of all, are you encouraging member states now to add to their fiscal support this year? And in addition, do you see any case for additional EU level action, or do you think that the focus needs to remain on implementing the existing package?
Well, to your first question, the answer is definitely yes. We are encouraging all European member states to keep their supportive fiscal policies. Um, well, there is a sort of mantra that we are all repeating in all these international meetings, that doing too little would be now more dangerous than doing too much, or that withdrawal of supportive measure premature is more dangerous than have a too late withdrawal. So this is what I think in all advanced economies, we are, not all, but more or less the big majority, we are repeating. And I think it's quite true for European Union, so true that we established criteria that will probably in May bring us to the decision to postpone to the year 2022 um, this general escape clause that is suspending the implementation of our fiscal rules. This is not something that we have already decided, but we, at the beginning of March, we established criteria, and after the spring forecast in May, we will take the decision. And of course, if we have this escape clause in 22, the reason is very clearly the fact that we encourage member states to continue in supporting their economy. Of course, we will need to be very selective in this activity um, going on in the next months and quarters, as Kristalina was saying, to make the right choices for sectors that have to be supported. Um, we have to avoid cliff edges because, for example, about bankruptcies, you know that we had the lowest level of bankruptcies since years in 2020 in Europe, and this is because of the uh, large amount of public money that was put as public guarantee, and because of the suspension of our traditional state aid rules. You know that we had 3 trillions of public guarantees authorized with this temporary state aid um, framework, despite the fact that then only 25% of this 3 trillion um, was indeed really used. But it was a large, so to say, bazooka in a table to avoid bankruptcies. But now this will be, of course, gradually phased out, and to avoid cliff edges will be, from the social point of view and for insolvencies, would be absolutely crucial. So my first answer is yes, we need to keep this support, and we have also the regulation decisions allowing us to keep this supportive fiscal stance for 21 and probably 22. On the second point, should we do more? Uh, of course, yes, in the sense that we need, and I repeat, we have also the regulatory decisions allowing this. We need to um, keep and strengthen the support at national level. As far as the European tools are concerned, I think we should first implement them. Um, because to open now a discussion on the amount of this next generation EU fund in the very moment where we are finalizing the national plans and the ratification process would be quite counterproductive. So now we have to implement this. And is it too late? Let me finish with this. Is it too late? Is it coming too late? Well, my answer is this is not emergency money. The emergency reaction was very strong from member states, with also through automatic stabilizers, as Kristalina just reminded. This common money is quality growth. This common money should be connected to the green transition, the digital transition, and reforms. This is the added value that we can have, having for the first time not only fiscal rules but also a fiscal tool.
Could I? Well, I've heard both of you talk about the need at some point to shift to more targeted support. I mean, this sounds easy enough when you think about it. Conceptually, it's clear what we're talking about, but actually discerning what targeted support looks like is actually very difficult when you start thinking about it. I mean, if you think about it in the context of the corporate sector, for instance, how do policymakers determine what is viable, what are viable sectors, and what are sectors which have seen irreparable change, a change that is going to be lasting because of the nature of the crisis and how the world has changed because of COVID-19. I wondered, first of all, Kristalina Georgieva, could you talk a little bit about how the IMF is advising countries to go about the process of determining what is changed beyond recognition and needs to, and in which case support needs unfortunately to be withdrawn, and what areas of the economy can survive but may need targeted and continued support for longer?
This is really at the heart of the matter. We know that despite the popular slogan, build back better, most of the economy is going to move forward. We are going to have very significant changes, and we are already seeing some of them in terms of digitalization, accelerated by the pandemic, in terms of the recognition that we have no time to waste to transition to a low carbon, climate resilient economy. And also the fact that we know this pandemic is deepening inequalities that have been going up even before we were hit by COVID-19. So when you look at the knowns, the known parameters are countries absolutely have to invest in accelerated digitalization. Areas that are left behind have to catch up. The education system has to be tuned towards a much more integrated way of learning with much more attention to skills for the future. And incentives have to be in place for greening the economy. This we know. And then we also know who are those that are more dramatically impacted: low skilled workers, young people, women, although in advanced economies there is a bit of catch up in the labor market as far as women are concerned. So on those, I think policies to be put in place are fairly straightforward, and they need to be articulated. Uh, I want to concentrate to one particular aspect because I think how we deal with it would have tremendous implications for efficiency and speed of transition, and it is on the climate side. What we recognize is that this transition would require three pillars and pursuing them at the same time, simultaneously. The first one is uh, carbon price and forward guidance, how this carbon price is going to go up over time. The second one, public investment in the green infrastructure, as well as in resilience. And by the way, this is where we can also gain jobs. If you take building, retrofitting, reforestation, land degradation, a big chunk of the renewable energy. And the third one is how we make sure this is a just transition, how we compensate for parts of the economy that are going to be declining with inevitable impact on firms and on people. So take that cluster of issues and then turn it into policy. And I think it would take a great deal of how we go about a, if you wish, industrial policy that is uh, both industrial policy and competitiveness policy at the same time. Uh, Obviously, countries will have to look at very carefully at firms in terms of their health and at the insolvency procedures they have in place, to what extent they are up to par. Fortunately, most of the European countries are in good shape in that regard, but one more look at these procedures would be necessary. And then turn attention to the investment in people, and in supporting with targeted hiring subsidies firms that are clearly picking up speed because of the transformation that is happening in the economy. There will be difficult questions ahead. I only hope that with the same decisiveness action was taken at the first round of the crisis, there will be action taken as we move towards the transition to the economy on the other side of this crisis.
Paolo
And by the
Gentiloni,
way, I'm sorry, just one
after you.
little point here. Warren Buffett has this great saying: when the tide goes down, we see who is swimming naked. So a bit of the answer to your question would come as support is being gradually withdrawn. But the second part of your question, how do we identify where support should go, is the tough one that policymakers have to answer.
Paolo Gentiloni, part of this debate obviously gets wound up with the whole question of the Stability and Growth Pact, which is currently suspended. At some point, it's clearly going to have to be reimposed. And yet the rules are arguably very ill-suited to a post-COVID world that we're going to find ourselves in. There are obviously now arguments from economists, including today Jean Pisani-Ferry and colleagues, that the 3% cap, the 60% debt to GDP ratio rule under the treaties are just obsolete, and we need profound reform of the Stability and Growth Pact. How far do you think this reform process is going to have to go?
I think it is strongly needed. Of course, this process also needs to be in a little bit more stable and less uncertain situation. This is the reason why at the moment we acted, and I have to say we acted rather quickly with extraordinary and temporary measures. In middle of March, we suspended fiscal rules and state aid rules, and then we decided this general escape clause, which is suspending the rules, their implementation, and probably will be prolonged for the end of 2022. So this is how we reacted immediately. Then we need, of course, to shape also what our rules will be after this pandemic, after this crisis, knowing that after the crisis, we will have mostly to face two challenges. One, of course, is the fact that we will have a higher level of debt, around 100% on average in the Eurozone. And this, of course, is very rather far from the target that we have in our treaties. By definition, a European commissioner is not discussing the treaties. We are presented as guardians of the treaties. But what I think is absolutely needed is to consider this reality for our rules. And so I think that by the end of the year, we will come with proposal to transform this, this framework with, I repeat, two issues. One is, of course, the issue of the high debt and how, with what kind of graduality and characteristics we can keep common rules and common targets without using our time to muddle through rules that we are not able to enforce. So this will be a first problem. The second problem will be to strengthen as far as possible the The second word that we don't use frequently of our stability and growth pact, which is growth. Because, of course, we will need in the next years and maybe in the next 10 years a higher level of growth for Europe. And of course, we need um, um, also from our rules the potential increase of this growth rate to be uh, possible, especially growth connected to the green transition. Because uh, I think if we are serious with the green transition, and indeed, I think the European Union has been very serious on the subject. As you know, we adopted this decision of the European Green Deal before the pandemic, and this was the initial idea of the von der Leyen Commission. But then we not only confirmed, but increased the ambition of this program during the pandemic, increasing our target of reduction of emissions from 40% to 55%. And in June, we will take the decisions connected to this target. But this target, which is very important also for next generation EU, you know very well, the 37% of investment, 30% of European bonds emissions. This target, this goal, needs an enormous amount of investment. And we should not repeat what happened after the previous crisis, where net public investment reached a zero level in the decades that we have behind us after the financial crisis. So we need a framework, and we will have a discussion with a little bit more certain environment in the, I imagine, the final quarter of this year. We need a framework from a regulation point of view, giving to our fiscal policy the possibility to be realistic about the debt and ambitious about investment. Because, of course, we need to have a stronger common fiscal policy. This is what the ECB governors, Mario Draghi and Christine Lagarde, have been repeating in the last 4 or 5 years. We can't have a monetary policy without we can have, but a monetary policy should be strengthened by a more coordinated European fiscal policy. And this is, I think, the aim of the discussion that we will have about our rules.
A question from the audience from Nuno Montenegro, who asked us about the unemployment outlook for the European Union. I might put this to Kristalina Georgieva, if I could, which is what is, I mean, it's the question about the scarring issue, really. How much will the nature of the jobs market change as a result of this crisis? In particular, should we be expecting in the European Union a very different labor market, a different structure of the European Union labor market and economy as a result of the COVID-19 crisis? Or the audience member asked, will things kind of rebound to where they were previously? What's the IMF's best guess on this?
Well, our best guess is that there will be changes in terms of skills that are on demand. And we will see inevitably more automation, more deployment of artificial intelligence, but also the way we work is going to change. Some of these changes are positive in terms of labor market dynamics, more flexible capacity to deploy skills. As we have seen, for those that are in the virtual economy, there has been really no crisis. One may say there has been a boom to a certain degree, But that then relates to skills. And there will be certainly a problem for people who are in the contact dependent industries, where a revival hopefully will come, but it would be combined with significant reduction of the contact that has been in the days before pandemic the norm. So we would like to see much more attention to upskilling, to investing in people, investing in education, investing in health, investing in flexible social protection. And we want to be sure that as we move towards the greening of the economy, it is also done with attention to job rich activities. So those who are in the area of low skilled workers, they can find deployment because of well thought through policies. So to finish, there will be inevitably increase in unemployment once there is restructuring, and firms that have been not viable but kept on life support are no more kept on life support. And that has to be anticipated. Policies that support people in a flexible way ought to be in place. And this is actually a very pressing task. If it is done, not necessarily we would see structural unemployment in Europe. If it is not done, there is a risk of scarring, longer term scarring in Europe and actually elsewhere.
We're unfortunately going to have to wrap it up in a couple of minutes, which gives me just a couple of minutes to ask one final question. One thing we haven't really touched on during our discussion is the tax side of, specifically the tax side of the equation. So we have obviously had very significant proposals for the global OECD tax process from Treasury Secretary Janet Yellen in the most recent days. And I wondered if I could ask both of you finally, as we wrap up our discussion, for your response to those. In particular, from the IMF's point of view, the IMF has spoken about the need for a solidarity tax on pandemic winners. To what extent do you see this as a step in that direction, and is it something that the IMF welcomes? And for Paolo Gentiloni, I wondered if I could ask, from the EU's point of view, there is obviously an ongoing discussion about a digital tax in the European Union. Is what Janet Yellen is proposing for the OECD, does that basically make the European Union's work in this area redundant? First to you, please, Managing Director.
We do anticipate that there would be more progressivity in taxation. We have to see a way for the high level of debt to be managed down, and both more growth but also more revenues would help. The fund has advocated for a long time, way before I started there, for minimal tax. Why? Because only if we have minimal tax, we can deal with tax avoidance and we can improve tax collection. We do want to see, however, attention being paid to the specific circumstances of developing countries. And we recognize that agreeing on the principle is going to be probably much easier than on the implementation details. We also welcome very much the progress made on digital taxation. Clearly, this is the big winner of this crisis, and where we can see lifting up society as a whole with a more thoughtful application of tax on digital services.
Thank you. Commissioner.
Well, in general, we are very, very happy of the fact that the new U.S. administration brought, in the framework of the revival of multilateralism, new proposals on this discussion on global taxation that was indeed in a stalemate. So the discussion is now revamping. I really appreciated what Janet Yellen proposed about the former the previous proposal coming from the US administration that she canceled. And the discussion will come. Of course, from our point of view, we have to make possible the fact that digital taxation and minimal taxation go hand in hand. This is what in the technical language of the OECD we call the Pillar 1 and Pillar 2, but we are cooperating to this solution, knowing one thing. You were saying, Sam, that we run the risk to have European proposal to be redundant. I am quite convinced of the fact that the very best on this subject is to have global solution. The second best, if needed, will be to have European proposals, and the more difficult situation is to have a proliferation of national solutions, which is what is happening now. And I think we are quite confident that with the new revival of multilateralism, we will be able to find a global solution and then to implement them in different ways in different areas and countries. So, of course, we will discuss because the criteria will be crucial. That US are proposing are not exactly the same that we are discussing, but I think that we can find very strong and common solutions.
That's an optimistic note to end things on. Thank you very much, both of you, for an excellent discussion. The sun is beginning to come out now in Brussels. Spring is in the air, finally here. Let's hope that with the economic outlook, that is also heading in a sunnier direction after this terrible year, 12 months that everyone's been through. Thank you very much, both of you, for your contributions, the excellent discussion we've had. Thank you also to the audience for tuning in, and have a great day. Thank you.